Well, record snowfall shut stores early and kept many shoppers home here on the East Coast over the weekend. But the question now is, can retail itself weather the slump in sales that we've seen over the year past, and what's going to happen in the year ahead? Well, joining us with some answers is Greg Melich. He's Managing Director of Equity Research in North America at Morgan Stanley. Excited to have you here, Greg. I've been reading your research for years now, and you're great at spotting trends. And before we get to sort of the themes for the next decade, for the year ahead, I want to ask you, just how much does this snow matter?
In the big picture, it doesn't matter that much. At the end of the day, people will get their shopping done. Might be a different day, might be a different avenue. For some retailers, maybe a little less margin, but at the end of the day, it doesn't matter that much.
So what's your outlook for overall holiday 09?
For overall holiday, we think sales will be down between 0 and 1%. And we think next year, our lead indicators are telling us it'll be a better year. Retail sales in the U.S. should be up close to 1%, so certainly better than the -2 or change this year.
Now, when we look at the question of the broader economic recovery, it keeps coming up, this idea of, will the consumer still make up, will consumer spending still make up 70% of GDP as it has for years now? Will the new normal reflect that? And you point out that the consumer really makes up only 18% of U.S. market cap right now. Will it get back to 25?
I wish it would, but really I don't think so. And I think the reality is, as the U.S. savings rate comes back to something that's between, say, 5 or 10%, and that will basically keep a check on what retail sales can do. There will be a recovery. Again, next year we think will be better. But we do think the new normal in U.S. retail sales isn't the 5% plus we were used to the last 20 years. It's probably more like 3 or 4%.
But will the consumer still be the main driver of economic activity? That 70% figure, will it still be that?
Well, what it'll imply is that inevitably retail sales will probably grow less than GDP. We can all figure out what nominal GDP number we want to use, but we think it'll be structurally a little bit less.
Okay. Well, when we look at the trends in that new normal, even if that's a smaller piece of the pie, what is it that's going to dominate? We hear so much about the Amazons of the world, the online retailers, but we've been hearing about clicks versus bricks and mortar for years now. Why is it different?
The big difference now, and you're right, trying to pick the winners and losers, it's about who really captures the internet and we think manages their assets particularly well. And your main asset is real estate, and it's your connection with the customer. And so for a lot of retailers, we think it's going to be rationalizing your real estate, investing more in your internet operations, and then finding out what really clicks with your customer, because that's where the money is. And back to your earlier question, I think it's worth noting, just because retail sales might grow sub-GDP doesn't mean there aren't retailers that'll do phenomenally well in this environment. It's still a very fragmented industry, so there will be winners and losers the way we see it.
Well, what's interesting with the online space, or with mobile, which you highlight as a big growth area for retail, is that people often say that feeds more discretionary purchases than the staples, that if you can buy it really quickly, it's almost going to let you have that impulse purchase happen more frequently.
I think that's true. It's certainly heavier in discretionary categories like electronics, for example, and less in things like food. But in terms of picking which retailers win and lose on that can actually be good, right? Retailers that have stores in areas like grocery or like auto parts, home improvement, areas like that, are less subject to internet disintermediation. People that sell large ticket branded items such as apparel and electronics, we think those are the areas that are at real risk when we look out the next 5 years.
You say in your research that Best Buy right now, highlighting one of those retailers, Best Buy is at risk of being the Barnes & Noble of electronics. What do you mean by that?
We won't live that one down. But what we mean by that is this. It's a great retailer. They've clearly won in their category. The question is, what percentage of the market can they really have and garner the returns they're historically used to? And ultimately, it looks like about 25%, maybe 30% of consumers are really willing to pay for having that big 50,000-foot superstore with all those electronics in it. Increasingly, and you can see it, just go this weekend, go to the mall or go to a Best Buy or go to a PC Richards, you name it, people will walk around with their iPhones, price comparing in the store. So something that you used to have to go home and do, you now can do real time, and that's true. It's happening in the mall. It's happening at retailers of sunglasses where you see people doing this. And we think that's an acceleration of the mobile internet that'll take e-commerce sales probably from 4% of retail sales today up to 6 or 7% in just the next couple of years.
Lastly, before we go, you say there's still too many stores out there.
We do. We argue that what's different about this cycle, every cycle has some similarities and some differences. Assuming jobs finally come back, and that's what we need if we're going to get retail sales to grow. That's a big if still. When that occurs, even if we got back to a 5% growth rate in retail sales, the internet exists now. It didn't 20 years ago. So that's effectively like adding 200 million plus of retail square footage. So we're going to need to take that sort of footage out, or we'll end up with an imbalance where returns are not going to get back to what we're used to.